The market for Open Door Technologies Inc., ticker OPEN, is currently closed as of the most recent close on Friday, November 21, 2025, at $6.75, representing a significant one-day jump of $0.59 or 9.58% on a massive volume of over 160 million shares. That kind of single-session move is not just noise, it's a seismic event that immediately tells us there is something far more complex at play here than a simple Friday afternoon bounce. The expectation, for anyone who has followed the iBuyer space, is that this stock should be dead in the water. After all, the fundamental premise of Open Door's business is currently being crushed by a high interest rate, low inventory housing market. And yet, the stock is up nearly 10% in one day, and dramatically so from its 52-week low. The reality that immediately throws a wrench into that prevailing bearish narrative is the sudden and pronounced institutional activity, specifically the recent announcement concerning a warrant distribution and the underlying sentiment that Open Door is not just a real estate speculator weathering a storm, but an entity actively transitioning its entire operating framework, a pivot that has clearly captured the attention of very large, fast-moving capital. This is the tension we need to focus on. The market is pricing in a transformation that its recent fundamentals clearly do not justify, and understanding that gap is the key to trading this stock. The general belief about Open Door is straightforward. It's a capital-intensive digital house flipper whose model broke when the housing market turned. The core mechanism involves buying homes instantly, often overpaying slightly for speed and convenience, applying minimal fixes, and reselling quickly for a small, predictable profit margin. When interest rates spiked, inventory dried up, and transaction velocity slowed, this model exposed itself to extreme inventory risk, forcing Open Door to hold homes longer and sell them at higher losses. This is the simple, easily understandable narrative that keeps many investors on the sidelines. However, the contrarian and deeper take challenges the idea that Open Door is still that same company. The reality is that the new CEO, Kostra Najantian, a former COO of Shopify, has been aggressively framing the company as fundamentally an AI company focused on operational efficiency and a far more disciplined, even skeptical underwriting model, specifically mentioning a shift away from a simple asset management focus. This rebranding and operational reset, coinciding with a massive year-to-date run-up from a near-death experience low, suggests that some sophisticated players are buying into the narrative that the new management can use technology to de-risk the home buying process to a degree its competitors couldn't, ultimately allowing it to become the low-cost leader in transaction services even if the macro housing market remains sluggish. The significant volume and price action from Friday is the market signaling that this pivot is gaining traction, despite the recent Q3 earnings report presenting a challenging picture. Looking at the recent stock movement, the period following the Q3 2025 earnings call in early November was characterized by extreme volatility, a classic reaction to a mixed and somewhat confusing report. Open Door missed on EPS, posting a loss of $0.12 against an expected loss of $0.07, but the reported revenue of $915 million was technically above the high end of their own guidance, even if it was a narrow miss against the loftiest analyst consensus. The immediate reaction was a sharp drop, as much as 20% post-earnings, driven by the wider-than-expected loss and the dilution fears triggered by the company's need to issue new shares to bolster its balance sheet. Yet, what we saw in the subsequent weeks, culminating in Friday's surge, is a classic whipsaw pattern where the short-term pessimism gets violently overwritten by long-term institutional accumulation. The volume surge suggests an organized response, possibly covering by shorts or new money taking a position on the newly articulated AI-first vision. Specifically, institutions like Jane Street and Renaissance Technologies showed massive increases in their positions as of the September 30th filings, and this pre-earnings accumulation gives a very interesting backdrop to the current price volatility. Insider buying also paints a compelling picture, with the CEO himself, Khosrow Nejatian, buying over $1 million worth of shares in early November, which is a powerful, if not always predictive, sign of confidence. For investors trying to make sense of this, we must talk about the elephant in the room: short selling. Opendoor has long been a battleground stock, and the recent price action cannot be analyzed without acknowledging the enormous short interest. Based on the last bi-monthly data from October 31, 2025, the short interest stood at a staggering 163 million shares, which represents about 24.6% of the free float. The days-to-cover ratio, a metric that indicates how many days it would take for shorts to cover their positions based on average daily volume, was around 1.6 days for the last reporting period. While that ratio might seem low, Friday's volume was nearly double the average, which is precisely why the stock jumped so hard. Immense buying pressure on the open market, whether from long-only funds entering or shorts being forced to buy back, collided with high underlying short interest. The rising borrow rates, which is the interest short sellers pay to hold their positions, also signal increased demand to short the stock, indicating that the bearish conviction is still very much alive, even as the stock price rises. Major firms are known to hold large short positions, operating on the thesis that Opendoor is ultimately an over-leveraged tech company whose housing bets will eventually unravel in a higher rate environment, especially if a recession hits. However, the counterpoint, the one that the institutional buying is betting on, is that the company is close to the maximum pain point for those who are betting against it, meaning a small piece of good news or even strong technical price action, like we saw Friday, can trigger a short covering cascade. Actionable insight here for retail investors is clear. You must monitor the next short interest report, which will cover the first half of November, to see if the recent price surge was accompanied by any significant short covering. If the stock price rises, but the short interest remains stubbornly high or even increases, it signals that professional short sellers are digging in, viewing the current rally as temporary. If the short interest drops substantially, it validates the idea that the underlying fear trade is unwinding. You can find this data on the Nasdaq website or through many major financial data platforms. Do not, however, chase the stock simply because of the short interest. A high short interest is not a guarantee of a short squeeze. It is simply a measure of strong, active bearish conviction. Chasing a short squeeze is a speculative act with extremely high risk. Instead, look for confirmation in the days-to-cover ratio next week and watch for unusual option open interest at key resistance levels, the $7.75 marks, as this can reveal where institutional players are hedging their bets or forcing the issue. What's your take on the rising short interest? Smart money or manipulation pushing for a technical squeeze? Opendoor's business model, for those who are newer to the stock, is the iBuyer model or instant buyer. It uses a proprietary algorithm to instantly price a home, makes a cash offer, purchases the property, manages necessary light renovations, and then resells the home on the open market, charging a service fee for the convenience and speed. The company's old expectation was to scale this model rapidly across the U.S., using technology to gain a speed and pricing advantage over traditional agents and flippers. The reality, as noted, is that this model is highly dependent on low interest rates, predictable home price appreciation, and fast transaction times to keep inventory costs low. When the housing market stopped moving in a straight line, the company's financials suffered immensely. Older reports, like the 2022 and 2023 figures, show revenue scaling up quickly during the peak of the housing boom, but the key metric of adjusted EBITDA consistently showed massive negative numbers, reflecting the core problem. They were buying and selling volume, but at unsustainable margins. The new CEO's focus, as stated in the Q3 call, is less about buying and selling homes at all costs and more about generating higher margin revenue through adjacent services, such as their Cash Plus product, and using AI to reduce their pricing error rate, which is the primary source of losses in their inventory. They are essentially trading high-volume, low-margin transactions for a more capital-light, service fee-driven approach, a pivot that, if successful, fundamentally changes the risk profile of the entire company. Looking ahead, the future outlook hinges entirely on execution and the macro backdrop. The most immediate catalyst to watch is the continued success of the internal transformation and the market's reaction to the upcoming guidance. If the company can show demonstrable improvement in its unit economics, meaning higher contribution margins per home and a lower net loss, that will be the fundamental signal that the pivot